Hello, everyone. Today is March 22nd, 2023. Hope everybody had a happy St. Patrick's Day. Today is the Fed Day. Yesterday started the meetings, and I'm watching right now, and everybody's anticipating what is the Fed's decision. I think I said last month I was anticipating a 50 basis point hike. I'm thinking now, because of what happened, what's been going on with the banks, they're probably going to reduce it. I know there's been talks that they're going to halt their deposit, but inflation is too hot, which I'll go over in a little bit. So let's move on. So let's start with the yield curve. Get my little pointer here. This was last month's. Everything from the 1 to the 5 years, you were still at somewhere above 4%, close to 5% in the first year. Let's look at now. This is from the 17th. This was from St. Patrick's Day. We have significant drop especially in the 1 to 5 years. Now you're getting 44 basis points on the 5 year. So quite a big drop on what's been going on in the market, and I think this had a lot to do with what's going on in the banking area. I was attending an investment conference and an economic conference in Las Vegas, and with this pretty much as it was unfolding, this pretty much had dropped. So like over here, you pretty much have like a little ski jump. Looks like a jumping area. So we'll find out what's going to go on today. Like I said, I'm anticipating it's on. If it comes on while I'm doing this broadcast, I will tell you. But I think I'm assuming. I shouldn't say assuming. I'm anticipating that the Fed is going to increase it, but about 25 basis points, just to kind of keep people at ease. But this banking thing happened. It's pretty much their faults. But that's for later slides. So let's look at inflation. Last month it was at 6.4, the headline, and the core, the sticky, was 5. And let's look at now. It went down 4 base. About 4 bips, but look at core. It went up 4 bips. So it took away from the headline, but it gave it to the actual. This is why I'm saying that they're going to still have to raise the Fed rates to cool this down. They want this number, 2.5. I think numbers are going to be different down the road with the employment issues, which I've stated monthly almost for the past year. But we'll see how that goes. But I'm anticipating a rate increase here shortly whenever Chairman Powell comes on. Let's move to the rate hike probability. So this was last month. This was February 16th. Right here. Look at the probability for March 22nd. 107% probability that they're going to raise it. And look at all the probabilities. It's all positive all the way from every meeting from March to July. It's positive. It's going to be a rate hike. Looking at last month, March was only 77%. But like I said a few months back, as we get closer to the Fed meeting dates, they do change and they go more higher up. And again, look at June. They're still high. They're drawing back here in July. But look at now. This is from yesterday. Had this pulled yesterday. Look at this. Only a 78% probability that they're going to raise rates today. And look at June and July, that they're saying that they're going to actually start tightening, and they're going to start lowering the rates. And you can see from the graph here, they're going to start here, and they're going to be moving them downward. So it's going to be interesting how this unfolds. There's a lot going on. There's a lot of chatter. A lot of people are saying they're going to pause it. They're going to pause it for the rest of the year because of what's going on with the collapse of these banks. Here's a new. It's not a new, but it's I haven't put it on before. This is the probability index. Look how high it was in February. That it was just they were just going to keep on raising it. 50, maybe there was even talks of some 75 points, and then the bank started collapsing, dropped right away, dropped all the way, and right now it's going to be interesting because I'm like I said, I'm saying they're going to raise them. They're going to keep on raising them. I don't think 50 like I predicted last month because of what went on, but I'm pretty sure they're gonna keep it at 25 basis points or 25% quarter rate hike, and they have to. The inflation is too hot, and if they don't do something, it's going to cause a lot of problems down the road in different areas. So it's going to be interesting how it turns out. So over to the aggregated bond market, the old Lieberman index, and you could see we're still on the rise. It ebbs and flows, but overall, yield to worst is 4.45. This is where I keep on saying people are going to be going into the fixed income markets because it's more stable right now, especially with a hike rate. Excuse me, can't even talk today. Especially with the rate hikes that have been going on, that's going to be like the safe haven for now, except if you want to get into gold or some of the precious metals also, that's a safe haven. The market is just too volatile right now. So let's look at CPI. So I shared with you this last month, and of course, like we're a month behind, so I shared it with you last month, but this is January's data. So let's look at February's data, which is new for March. Look at the food and all items, they just keep on going up. Meats have gone up, fruits and vegetables have gone up. Then you look at all other items, less energy. Everything's still on the rise, and this is the problem that's causing the inflation. And yeah, food is a driver, but the main driver is still housing. Housing's really bad. So this is the CPI index just for the western region. So here in Santa Fe, here in New Mexico, Arizona, California, all those regions right here, this is where all items are, and then you got your all items less food and energy. So it's still relatively high. You could see where they started dropping. This is when everybody got happy last year. They're like, we're going in the right direction, and it kind of just did some side action here and just barely dropped a little bit. So not where the Fed and everybody's anticipating that we should be at, where we should be at right now. So it isn't going down as fast as it rose. So another indicator of the Fed's hiking the interest rates, looking at the PCI, I get confused because they say the Feds look at PCI, and sometimes they say we're not including housing because housing it's happening too fast. We can't get good data, and some of them are saying we're not adding food, but I get mixed signals, so I added it in here. But you could still see it's still gradually climbing, so still a problem. So this is why I'm saying they're just going to keep on raising the hike. Like I said, I can't speak today. I'm sorry, folks. They're going to be raising the rates for the rest of this year. Wanted to share with you again the CPI, and I just highlighted these are all the sectors, but I just highlighted all items, food at home, shelter, and food. So these four groups, and you can see over here there's been steadily between a year, everything was in a high movement, and you can see here around November, December started coming back. But if you zoom in closer, housing is still continuously rising up. Again, food's no better. It's come down some. These are the two foods and all items, but they still need to come down significantly before we see anything. The Fed's starting to lower the rates. So we have a long way to go, and I'm thinking that they're going to be raising for the rest of the year. So here's something interesting. And some of you may have noticed, some of you probably haven't noticed. I actually noticed in November during Thanksgiving, going to shopping, went to go get my favorite sweet potato pie. My sweet potato pie wasn't as big as it used to be in the past, and it was the same price. Actually, it was a little higher, and I'm like, what the heck? What's going on? The same with breads. Some of the paper items, they're not as big as they used to. Toilet paper, I've noticed that. I was passing by the aisle, and I noticed they don't have those big packages anymore. They have something similar, but it's not the same amount for the same price. So this is something that they're calling downsizing or shrinkflation. So guess what? Look at all the household paper. So they're downsizing the items to make them look like they're the same size, but they're cutting back on the number of sheets. The sizes might be a little bit smaller. Look at the snacks. I noticed this. My mother likes pretzels, and I noticed that the bag isn't as big as it used to be. And some of the ones that are the same size, there's just not enough pretzels in there. But it looks like it's across the board. This is going on. So, excuse me here. The chairman, so you're hearing it here, the chairman just announced a quarter increase, and he stated that they can still have the autonomy to increase at any time. So there you hear it, folks. 25 bip hike. So there you go. So back to the shrinkflation. These numbers are also not really considered, I don't think, into the CPI. I think if they put all this numbers and datas in there, the numbers are going to be changing a lot. So we're going to be, at an inflation level for a while. It's a kind of a neat way what they're trying to do to make it look like we're still giving you the same amount of items, but it's actually for less. Here. So last month we were down. Cooling the market has been down for a while. But look at this: building permits and housings have started. The permits in the actual building of houses have gone up in February, and a lot of sales have been started in February too. And I think a lot of people are thinking, we better jump on it before the rates even get even higher down the road. So, what I've been telling people, it's like, we'll get them now. When the rates go down, just refinance it at those lower levels, and you may pay quite a bit for the first year or so while inflation is high and the Fed funds are high, but they're gonna eventually come down, so you can refinance it. But at least you have your home instead of waiting for 3-4 years down the road when the housing prices are going to be more expensive anyway, and it just doesn't make no sense. So some shimmer of hope here, especially for those that are looking to get a home. The index, the average 30-year mortgage, you're looking about 691 is the mid price for the mid average for the mortgage rates. So still high, but a long way to go until it gets back to those 3%. But just hang in there. It'll eventually get there someday. But it's just better to jump on a home before you see these again when they keep on raising the interest rates. So jump on it now, folks, while you have an opportunity. I've been hammering this in for over a year already. The civilian labor force, it's still low. It's like you can see that's high point way before the last financial crisis, and after people just got out of the workforce, came down, Of course, here again, it was the pandemic, and it just hasn't rebounded to where it is. I know they keep on saying this many jobs were added. I think 300 additional farm credits were added this time around, but the workforce has just reduced. So you can see this is now this month, last month, this month, last month. So you just barely see it moving, creeping up. So if you look at the overall amount, you got the white labor force, and the totals are almost on top of each other. You got way up here. You got men 20 years old and older, higher percentage, and you look at the teenagers. Well, of course, teenagers, they work part time. There's they sometimes the parents tell them, I'd rather you study instead of going to school. And some of them still have to go to school because they have to support the family as well. But you look where they jump from here to here, and that's the big force. What would be interesting if I could get some Hispanic and black population to see when at their ages at 20 years, from 16 to 19, and from 20 years and older. It would be interesting to see where those facts are. But this is kind of interesting graph. But you can still see that it's still down on every segment is still down in the workforce except for the teenagers. Teenagers are kind of up to about 2019 levels. But they're finally starting to come up with data that I've been saying for quite some time. Here's the unemployed workers to the job openings. So right now you got way more job openings than you do have unemployed workers. So it's an interesting chart, but it actually gives you a visual to what I've been saying. And if you look at the employment over since 1950, you can see, and this is where I kind of made it, where it's the baby boomer era, where they kept us working for a long time. You got the World War One, World War Two men of age and women that were keeping the labor force up there. And then you could see this big drift. Well, the drift went up at its peak in the close to the end of the millennium, and then it started just dropping off. And this is where I keep on telling people, well, that's why during the pandemic, these people were close to retirement, and they just said, you're so close. Here's a severance package. We don't know how long the pandemic's going to last. Whatever stories they made, and a lot of them exited the workforce, 4 million. Now we're having trouble finding them. In governments, we're having trouble finding employees because we can't keep up with the private industry, because they can keep and attract them with higher pay. Of course, governments have better retirements and benefits, but when you're younger, you don't think about that. You want the money. So this is a beautiful chart right here. You can actually see the overlapping, and you could see where this side on the left is a percentage of Americans, and then it's by the number of employees. But you can see the ages, and as they get old, as the baby boomers have moved up into their ages, into their brackets over the years, it's coming off, and the employment in the labor workforce is coming down. And here on the right, you can see how it's overlapped as well, and you can see as they're 55 and up at 2020. That's where the highest. Let's see, the 55s and the 25 to 34s were the highest employed up to 2020, and that changed. So it's really interesting, and you can see, here is the pre-pandemic levels of a workforce, and then post. And you could see this area here is probably the 155 million jobs that are available, but there's just not the workforce to do it. So like I stated earlier, 311,000 non-farm payrolls were added in February, and for a total of 155 million jobs available. And the sectors that picked up a lot of those employees were leisure, hospitality, retail, trade, government, and healthcare. So those are the ones that picked up those employees. Still, there's still a big deficit of people missing. Some takeaways from the inflation is CPI is still remaining high. Food prices are still on the rise. Jobs are up. Job participation down. Cooling of the housing and building market, but it's starting to heat up. So we'll see. Stay tuned. We'll see how effective that is and how long it's going to last. And then the Fed hike in January was almost ineffective. I just told you now the chairman announced a quarter percent hike in the Feds. So we'll go over what's on everybody's mind right now, the banking industry, what's going on in there. So we got the great March banking slide off. What's happening right now, and
about the $20 you owe me.
Oh yeah.
This with you.
Well, I only got 10, so here's 10. I owe you 10.
Thanks.
Hey Mo, you owe me 20.
Well, here's 10, and I'll owe you 10.
You owe me 20. Here's 10. I owe you 10. Here's the 10 I owe you.
Here's the 10 I owe you.
Here's the 10 I owe you. Good. Now we're all even.
Stooges, who love them. So it's kind of what's going on in the banking industry, sadly. But let's look what happened. In the past few days, what's went on. So let's go with March 8th. This one isn't really announced too much because it's Silicon Valley one that you hear all the time. It's Silicon Valley, this and that. But it was actually Silvergate Bank that started it, and they were invested heavily in the Bitcoin area, the digital money. They were overexposed. A lot of their depositors found out. They made a run on the bank. They wanted their money, and they wanted it now. Moving to March 10th, 2 days later, run the same thing. A run on Silicon Valley. They heard some weaknesses in there. Their main problem was they were overexposed on their interest because they went farther out on the curve during 2020 because they were paying interest to their bank. They're customers of the bank. They're paying their interest, and then they had to keep the liquidity, so they went farther out on the yield curve. So that left them way exposed. Now for last year that we've been raising the rates, so they had a big amount to write off, and people heard about it, got word about it, and made a run for the bank. They wanted to get their money in full. March 12th, Signature Bank. Looking forward, giving back. Well, they again had problems. Same thing, some in the digital area, the digital money, and that one fell 2 days later. Then on March 13th, President came on, reassured the nation that this was just an anomaly, that that all the banks were fine, and that we were safe. Well, that afternoon, First Republic Bank failed also, and this one was interesting because it was a lot of customers that had over the amount of the FDIC insurance in their accounts, and they wanted to pull it out to make sure it's safe. So they ran that bank and closed it as well. So a lot of these stocks, folks, were like at $200. Some in that area, some about a 186. But anyways, their stocks went from, I think First Republic's was at two something stock, 200 and some, and it went all the way down to $14 within 2 days. It's ridiculous. It's just how bad it is. And then you got a Credit Suisse, which everybody's heard that UBS bought them, but there's had a lot of problems, especially in the credit area. They extended credit to a lot of places there in Europe, so they've been on the forefront for a while, and it was just a matter of time. But UBS bought them up. So I think this is going to start a domino effect on a lot of banks, and I think a lot of people are going to be running to their banks and pulling out their money. I think a lot of them might be overexposed. Again, on the investment side, they went outside, and I think they're going to pop up slowly and surely here. I think this is just the beginning of it. Been saying for a while that the banking system hasn't been strong for quite some time, and I think it's never really not survived, but it's never really recovered since 2008. And I think people are just looking at that now, and I thinking that once these audits come through, they're going to say, hey, you're overexposed in long-term investments or in the credit area. I think a lot of these banks were involved in shadow banking, meaning that they were the middleman for other investment groups, that they used them as the middleman to get additional credit or funding for projects or companies. It's hard to say that's a problem, but I'm willing to bet that somewhere along the line it's going to be some kind of a credit issue as well. So stay tuned on that. It's going to be interesting, and I don't like to give too much advice on stuff because I don't want to fall back on me, but I've been telling people especially family and friends that know me, and some of my workers, my coworkers, I've told them a couple of times, you might want to consider not keeping too much money in there. And it's funny because they said that I must have a crystal ball, because I told this around November, December. I said, the banks fall, they're going to close up on a Friday, and you're going to have trouble getting out their money over the weekend. Well, this happened with Silicon Valley, so it was kind of funny that that came about. But we just got to just be careful and do our own diligence. We need to know how much money we should keep at home, or some other sources where it's readily available, and if this would happen to us, at least we have stuff to get us through at least a week, or maybe a weekend, a week in advance, to have it there until everything fixes itself out in the market. So data is only two-dimensional. Economics is 4 dimensions with real-life variables that makes it hard for actual predictions. I put this on there because I attended a seminar, like I said earlier, and there was an economist there that he was all with data. Data was everything, and he said, nope, the data shows this, and that's where it's going. Well, the funny thing about it is he had data about the Fed rate going to be raising all this year. But then look what happened. Real life happened, and the banks happened, and it just up till just a while ago, everybody figured there was going to be a pause because what's going on in the banking world is detrimental. But that is data. You can throw data at anything, and I appreciate that. It's just it's a neat thing where everybody can do and get analysis and get data, and they can try and go a certain way, but you never know in economics. Like I've said several times, we don't have a crystal ball. We can't say this is what's going to happen. It's like we look at stuff and we see the different variables. I'm one for that. I've never been optimistic or pessimistic, but I kind of like watch what's going out there in the market, and I share what I find out with you guys. So I put this in there because it's funny when people start going in that direction. It's interesting because some of them, the same gentleman last year said, "Oh, we'll be out of the inflation by September, October of last year." And I was like, and I even told him, "How can you say that with inflation so hot?" And he goes, "Well, we don't know what's going to go on with Russia." Well, Russia had just started trouble last year. It was I think in February, March. Anyways, I'm like, what about gas and everything that's out there? So anyways, it's just funny, or I find it funny. But anyways, so investing in this environment. So again, here's the dot plot. This is going to change, I'm pretty sure, real soon when it's available. But this is the latest one, and you can see that they predicting over 5 for this year till the end of this year, and then next year maybe a little bit over 4 and 25. So always go off that, and I look at how the rates are, the projected rates, and I make a graph where it's easier to explain. So what we've been doing and what we like to do, like I said, this everybody has their own methodology. This works for us. It works for some other of my peers, but we invest on shorter term durations all the way up the rate hikes. Then as it's coming down, we anchor those longer rates in for bullets, so we can get those longer and higher interest rates for the duration of time. So what we're looking at in that is short-term treasuries, of course, and you got commercial paper, 120-day max, brokered CDs, 6 months to 5 years, and they're out there, and there are actually some really good ones out there right now. So if you're looking to ladder some good ones out, or if you have some cash flow you need to make within a few months, look at those will help you out. The 1 to 3 year fixed income with or without call options to include short-term strippers, 3 to 5 year bullets to anchor higher interest rates. Another one that looks pretty good is the Freddie K's, which are another fixed income type, fits in that same area, and those are 5 years, and you're locked in at those rates for the 5 year duration. So those are another option to look at. But like I've said before, everybody has their own methodology. There's no magic recipe. It's I always tell people, just watch your cash flow. Cash flows makes or breaks you. So watch your cash flows. So again, this has been Patrick Varela from Santa Fe, New Mexico, and it's been a pleasure being here with you